Chapter 5: Central Bank and Banking System. We are going to discuss the history of Central Bank of the Philippines. The basic idea behind central banking is the discretionary control of the means of payment or money in a given community regardless of the form they take. An attempt is made at describing the evolution of central banking in the consciousness of the Filipinos, since written records have been available on their community, to mark off the milestone in the evolution of the Filipino experience with discretionary monetary system. The historiography proceeds on a chronological sequence.
On May 19, 1571, Miguel Lopez de Legazpi conquered Cebu and vanquished Raja Sulaiman, taking possession of Manila. The Spaniards had been bringing with them money from Spain, but these coins were cut into different pieces to meet the demand for fractional currency, and coded in Tagalog names as the rupee. A rupee is an original monetary that lacks a fractional currency that was cut into different pieces and its parts given Tagalog names. From the 1570s on, Filipinos have widely used money silver coin and gold coin, both of which circulated all over the Philippines at that time. Thus, Spanish officials were paid salaries quoted in gold pesos. However, Manila has always been short of money, so that its exchange value depended simply on its scarcity. This shortage of cash was relieved by prohibitions of the Spanish colonial government in 1764, and later, in 1878, against circulating counterfeit money, both of which decrees failed to produce the results intended by them. However, the Spanish colonies in America revolted and won the sovereign right to coin their respective currencies, and some of these found their way to Manila. The galleon trade between Manila and Acapulco from 1565 to 1815 turned out to be an effective transmission mechanism of this plethora of Spanish and South American coinage. At the same time, it enabled Spain to consolidate its control of the Trans-Pacific trade for 250 years. To relieve the sheer scarcity of money throughout the country, the Spanish colonial government had no option but to authorize their circulation in 1828 after stamping them in Manila. As these borrowed coins circulated in payment and settlement of economic claims, the public officials in the counting house kept their accounts, tracked their accounts, and recorded transactions in pesos, reales, curators, and maravedis. There is evidence showing that in the 250 years since 1570, both silver and gold coins were widely accepted throughout the Philippines for settlement of economic claims. However, on March 31, 1837, this requirement was lifted as decree was issued authorizing the use in the Philippines of gold and silver coins that minted in China, India, Mexico, South America, and Spain without restamping them for circulation in the country. On September 29, 1845, this authorization was reinforced by the order of the superior government and Captain General of the islands.
On May 19,000, General Otis turned over his job to Major General MacArthur as the next military governor. This extensive occupation of country required substantial expenditure on soldier pay and procurement of local materials and supplies. Moreover, running the civil affairs of the military government also meant additional expenditure. By law, the American soldiers had to be paid in U.S. currency. They also remitted to their farmers but in the United States in U.S. currency, a big part of their wages. On the strategy of the occupied Manila, the U.S. military government brought along with them from San Francisco, California, a wealth of gold coins, silver, nickel, and copper coins to pay the Army and Navy, as well as for local procurement of materials, and supplies. Before January 1, 19,000, all payments were made in gold coins, which in no time vanished out of circulation. Afterwards, more than half of the payments were made in US paper currency. On the other hand, the local community of indigenous Filipinos and Chinese Filipinos have been used to the fiduciary silver coin system. Accordingly, they hesitated to accept the US currency as means of payment for settlement of economic claims because trade, wage payments, bank loans, and deposits, bank foreign exchange operations were at the time of the American military occupation of the Philippines through April 1898.
Now let's talk about what happened during the Japanese occupation. During 1941, the transition period was disrupted as the United States on 26 of July 1941 barred Japanese ships from during the Panama Canal and froze Japanese assets in the United States. Reason: American fears of Japanese intentions on the Western Pacific had initially been aroused by the outbreak of the Russo-Japanese War in February 1904 over Russia's emerging threat of a protectorate in Manchuria. But that was years ago, so how does it really affect? Let's look back what happened. During 1904, United States managed to keep its neutrality on Russo-Japanese War until Japanese Navy destroyed Russian Baltic Fleet on 1905. Because of that, the American naval planners in Washington, D.C. got serious about developing in the Philippines a naval base where American battlefields could be brought together and maintained. After the dispute of where the American naval base to locate, whether in Guimaras Island in Visayas or in Subic Bay in Central Luzon, President Theodore Roosevelt, along with his cabinet, confirmed the General Board choice of Subic Bay as the location of the United States Naval Base for its Asiatic fleet in the Far East. 10 years later, 1915, First World War. Over the next 15 years, political stability was eroding in Japan when the Hamaguchi government agreed to an extension of the Naval Arms Limitation Treaty for another 5 years. It disappointed the High Command of Japanese Navy. In 1931 to 1932, Hamaguchi and 2 other cabinet members were assassinated, triggering a prolonged crisis in the cabinet. This crisis involved the Japanese army in Manchuria to attack and subdue the Chinese garrison and key cities of Manchuria. During that time, Washington, D.C. had been relying on the assurance of Prime Minister Taro Katsura that Japan had no aggressive design on the Philippines. They eventually blew up in early 1933. Japan walked out during a session of the League of Nations that adopted the Lytton government shall submit its acts relating to currency, coinage, export, and imports to the President of the United States for approval. It also enjoined the new Philippine government to keep servicing its debt, including those of its subdivisions. It reserved authority to the United States President to suspend the implementation of any law, contract, or executive order that he, in his judgment, will compromise the ability of the Commonwealth government to comply its debt service or that will impair its currency reserves.
War period. The American Liberation Forces reoccupied Manila in February 1945 and completed in July 1945. The plethora depreciated Japanese military notes and Commonwealth currency issued during the occupation made monetary chaos and contaminated the post-war or victory peso. As more and more places in the country were preoccupied by the American forces, they flooded the countryside with hundreds of millions of victory pesos. Quezon, before leaving Corregidor Island to set up temporary capital in Cebu in 1941, had turned over to MacArthur more than $500,000. By the time Quezon and the family were airlifted from Cebu to Australia in February 1942, Gold Exchange Standard Fund had broken. As a consequence of victory liquidity, inflation occurred. The cost of living soared 6.5 times to 1 trillion pesos, compared to pre-war level of 120 million pesos, or by 8.3 times. In this economic mess, commercial and industrial areas of the Philippines, 50% of Manila was damaged, 70% of Cebu City, 70% of Iloilo, 35% of Bacolod, 90% of Zamboanga, and 85% of Davao. By the time Japanese forces capitulated, the country has lost 2,600 million pesos. The infusion of more liquidity went on unabated for a while as the Tidings Philippines Rehabilitation Bill was enacted into law by United States Senate on December 5, 1945. The Commercial and Foreign Exchange Policy legislated into the Belt Trade Act practically shrunk the policy options of both Osmeña and Roxas government.
The financial system plays a pivotal role in the development of a nation's economy. It serves as an intermediary between users and providers of financial resources. Deposits are known as savings and channel this in the order productive use by ways of credit extension. Financial institutions constantly expose themselves on risky businesses like banking. This is where supervisory authority stakes matter. They ensure the financial intermediation is conducted in an efficient manner. The central bank is responsible of overseeing the operations of banking institutions and financial intermediaries with quasi-banking functions. It is consistent to promote economic growth. Part of the supervisory authority's duty is to ensure rules to establish prudential standards for uniform applications for financial institutions. Examinations and regular investigation is being conducted to ensure compliance with laws and regulations to see whether a business is conducting a safe and sound basis. It assesses general performance and condition of financial institutions.
Major provisions contained in the General Banking Law. Number 1. A strong legal basis for consolidated banking supervision. Number 2. Adoption of a fit and proper rule for individuals that is appointed as bank directors. Number 3. At least 2 independent directors in the board of directors is required. Number 4. Formal adoption of a risk-based capital requirement along the recommendation of Basel Committee. Number 5. Comprehensive coverage of the single borrower's limit to include guarantees. Number 6. Stronger safeguards against connected lending. Number 7. Liberalization of foreign bank ownership of existing local banks up to 100% during a 7-year window of opportunity. Number 8. More flexibility in visiting banks on site in connection with supervisory matters. Number 9. Inclusion of the declaration of bank holiday as a ground for placing a bank under receivership. Number 10. The legal basis for the formulation of standards for determining unsafe and unsound practices of banks, quasi-banks, and trust entities. Number 11. Greater transparency and disclosure standards for banks. JBL gives a broader definition of supervision. The issuance of rules of conduct of operation for uniform application to all institutions covered, taking into consideration the distinctive character of the operations of institutions and the substantive similarities of specific functions to which such rules are applied. The conduct of examination to determine compliance with laws and regulations if the circumstances so warrant as determined by the Monetary Board.
The banking sector. The institutions comprising this sector are the universal banks, regular commercial banks, strip banks, rural and cooperative banks. Commercial banks offer the widest variety of banking services. The non-bank financial intermediary sector. The component institutions are not banks, but are subject to regulation by the Monetary Board of the BSP. They fall into two groups: those with quasi-banking function and other non-bank financial institutions that are subsidiaries and affiliates of banks and quasi-banks. Investment houses. Their principal role, therefore, is capital formation, and they are empowered to engage in other activities such as financial consultancy, portfolio management, assistance to companies in mergers and takeovers and stock. Financing companies. Minimum paid-up capitalization of financing companies is as follows as 10 million for the Metro Manila area, 5 million for first-class cities outside Metro Manila, 2.5 million for second-class cities and first-class cities and second-class municipalities, and 5,000 for third-class cities and third-class municipalities and below. Pawn shop. They may be organized as a sole proprietorship by Filipinos, or as a partnership with 70% of the capital subscribed by Filipinos, or as a corporation with 70% capitalized by citizens of the Philippines. Non-stock savings and loan association. These associations.
Market intervention. Open market operations involve the sale or purchase of securities by the BSP to withdraw liquidity from or inject liquidity into the system. These are the several advantages of open market operations. One is the flexibility exists both in terms of the amount and the timing of intervention. Two is the BSP has the initiative. For instance, when conducting open market operations, where areas in the case of free discounting, it is the financial institutions that decide whether and how much to borrow. Lastly, open market operations transactions are voluntary and done at interest rates set by the BSP. Rediscounting. Rediscounting refers to transactions whereby the BSP extends credit to a bank collateralized by its loan papers with customers. This instrument plays a dual role. One, as a tool to allocate credits to preferred sectors of the economy, and two, as an instrument to influence the supply of money and credit.
The Philippine banking system is composed of universal and commercial banks, thrift banks, rural and cooperative banks. Rural and cooperative banks are the most popular type of banks in the rural communities. A nation's banking system is fundamental to a healthy and properly functioning economy. Banks are the middlemen among suppliers and users of funds. And when they go broke, there's hell to pay. We should understand the Philippine banking system, how it works, and what its strengths and weaknesses are. Financial institutions. The Central Bank. The Bangko Sentral ng Pilipinas, or BSP, is the central bank of the Republic of the Philippines. It was established on the 3rd of July, 1993. Pursuant to the provision of the 1987 Philippines Constitution and the new Central Bank Act of 1993, the BSP took over from the Central Bank of the Philippines, which was established on the 3rd of January 1949. As the country's central monetary authority, the BSP enjoys fiscal and administrative autonomy from the national government in the pursuit of its mandated responsibilities. So here are the types of banks. BSP organizes its regulatory function to monitor and regulate 4 different types of banking institutions. First one is the universal and the commercial banks. This is the core of the banking system. Full-service banks accept deposits, make loans, and provide fee-based services. Universal Bank also provides investment banking functions. The thrift banking system. The thrift banking system savings and mortgage banks, private development banks, stock saving and loan association, and microfinance thrift banks specialized institutions that help small and medium enterprises and individuals with working capital and business products. So, the Rural and Cooperative Banks, a small local institution that mainly assists farmers during the farming cycle of planting to get good to market. Rural banks and cooperative banks differ by ownership. Rural banks are privately owned and managed. Cooperative banks are organized and owned by cooperatives. Non-bank with quasi-banking systems. Institutions that borrow funds from 20 or more lenders for the purposes of lending or purchasing receivables and obligations. Regulation of non-banking functions such as trust companies and pawn shops also falls within the jurisdiction of the BSP. We will attend to those activities after we are done with bank and quasi-banks.